Thanks for joining David and I for our educational video for the month of August. Kevin is on a well-deserved vacation. We thought we'd actually just talk about, some of the more frequently asked questions that David and I and Kevin have gotten over the last few months. David, how do interest rates affect my investment?
Sure. Interest rates affect your investments and the markets in many ways. Obviously, interest rates are a driving economic force. So when the Bank of Canada here in Canada sets interest rate policies, the lower the interest rates are, the easier it is for people to afford things, to get loans, to pay for their mortgage. So when interest rates are low, there's a little bit of extra money that people may have that they can then turn around and spend on vacations, other products and services. But when interest rates go up, that extra money disappears to a degree, right? And then people feel a bit of a financial pinch, obviously. And so when there's extra money in the system, when interest rates are low, that can cause prices of things to increase because people have a lot of demand for things. They have the money to spend. And so there's lots of money competing for a finite amount of goods and services. Conversely, when interest rates start to go up, or as we've seen in recent months, prices started to go up, inflation started to run away, the central banks have to step in and raise interest rates, and that helps cool that demand. And so when it comes to your investments, though, rising interest rates or falling interest rates have a lot to do with how your investments are going to perform, because for stock markets, a lot of stocks are valued on future earnings. So the potential a company has to pay you over the next 5-10 years in dividends or just stock appreciation. And so when interest rates go up, the cash flows of that, the future cash flows of that company are discounted against today's interest rates. And so when interest rates go up, a company has to make even more money for it to seem that much more profitable. When interest rates go down, it's easier for future cash flows to look attractive. And so that helps move stock prices, it helps move bond prices, and as we're seeing now, in recent months with interest rates having gone up, it's affecting house prices too. So the interest rate is really critical to inflation and our investments.
That's actually unbelievably great points, David. I had a real life example of that. We had a young couple that came in to the office that we were building a plan, and they had a variable mortgage, and their mortgage was about $1 million, and they've seen interest rates go up 2% since they originally took out that variable mortgage. And so what that means in dollars and cents is that they just added $20,000 a year of extra costs without really getting any added benefit. And so now that extra $20,000 is coming off of their disposable income. So as David talked about before, you can see the effect that rising interest rates can have and why it can affect the prices of stocks, bonds, and also real estate. And other items, because if you have $20,000 less, then you're probably traveling less, you're probably buying less items, you're probably going out to dinner less. So all of these things domino, with interest rates. Mm-hmm. Another question that we've had is when will the stock market turn around? I wish I had a crystal ball and I could tell you. If you knew that, you wouldn't actually need to be seeing David and I, because you could predict everything. One of the things that economists and David and I try and do is maybe get some hints. No one can predict it for sure, but you can get some hints. David just talked about how interest rates can affect the pricing of real estate, of stocks and bonds. And it really is the biggest driver. And so because of that, you can usually get a little taste of what's going on by listening to the different central banks around the world and the different governments. If they become a little more dovish and suddenly things look a little better, the market's going to respond positively to that because they know that interest rates won't continue to go up. They may start coming down or easing, and that's going to give them a little excitement, and you should see things pop up. Reversely, if inflation is running rampant and wild, and the governments are, taking a hard line on it and saying raising interest rates, you're probably going to see the market delay its recovery a little bit until that starts flattening out. So again, there's no perfect method with it. You can try and take some tidbits of information, but one of the things that always happened 100% of the time is after there's been a bad market, the market has reached new record highs and taken off again. So we know that this is going to happen. We just can't predict the exact time frame on it. David, how should people manage their investments in the current volatile market?
That's a great question, Harry. I think that in volatile times, often it's useful to try and stay calm, keep cool, and just maintain some perspective. Like you just said, anytime we go through a downturn or a crash, we always get a recovery. Sometimes it takes 6 months, sometimes it takes 18 months. In 2008, it took about 3 years, after a real massive one. And so it does take time, but if you can maintain perspective and just recognize that eventually you will get back to those peaks, it's just a matter of when. Which is obviously a lot easier said than done. We recognize that. But that's why we're here to help people sort of get through those tough times, to have conversations. Another thing that I think is really useful for people to do is to take note of like how you're feeling. When you look at that second quarter statement, you do see a loss. Like, how are you feeling? Are you worried? Are you panicked? Is it like water off a duck's back for you? Do you not even really care? Because those are all important things to communicate with Harry and I about. Because if you are worried or are panicked, we wouldn't recommend making wholesale changes when things are down. But it's good for us to know that, hey, if you can't sleep at night because the portfolio is down 10%. That's useful for us to know, because then tactically when things do recover, we can have a conversation with you about, hey, this is how you were feeling in the last downturn. Maybe we should make your portfolio a little more conservative in preparation of the next downturn, which may occur 3 years from now, 5 years from now. We don't know. But those are all useful things to have conversations about. And conversely, if you're somebody who's not worried about it at all, well, maybe we need to look at making your portfolio even a little bit more aggressive to maximize future returns. And that's another thing too that people can do during these times, is just look at rebalancing. Again, stock markets have had a nice little recovery here in July and so far in August, but when things are down, when your riskier assets like your stock portion of your portfolio is down significantly, it's usually a good time to look at rebalancing. Maybe you actually take some of the assets in your portfolio, like some of your cash or some of your bond funds, and you buy a little bit more stocks. It doesn't have to be massive adjustments, but 5%, 10% here and there can help in that regard. Or if you're somebody who's still working and has income coming in, or you've built up some cash in a savings account, oftentimes when the market's down 15-20%, that's usually a great time to buy when you've got a time horizon of 3-5 years. So those are all little things that can be done, but obviously the main thing is just to try and keep a level head and talk to your advisors.
Great advice, David. And as always, if you have any questions, please don't hesitate to give David or myself a call. And remember, we've planned for all of these scenarios in your financial plan. So we didn't originate making these plans predicting that you're never going to have an off year. We know that you're going to have an off year. It's just natural. So again, don't worry about it. Call us, and we're happy to help out. Take care.
See ya.